Great. All right. So we want you to think back to the year 2001, a very infamous year in the accounting world. So what happened back in 2001? What major event shook the business and accounting world to its core? Well, the infamous word that is continued to be repeated in every single business class across the United States to this day is Enron. So what happened? Without boring you with the history and the specific details, there was a major scandal. And the effects of this scandal was that it caused the downfall of an empire. It destroyed the finances of countless families. It had almost irreparable damage to the stock market and totally caused the distrust of the public. Well, what precipitated from the scandal was a sweeping set of business and financial legislation that was aimed at increasing transparency and trust, and also increased the liability and responsibility of CEOs and CFOs. So what we're about to share with you is just as shocking as this Enron example, except for that was for publicly traded organizations, publicly traded corporations, and what we're about to share with you is in the nonprofit sector. So we urge you, as we share this presentation with you, to think critically. We want you to think about the differences between what happens in the profit sector for publicly traded organizations versus that and the discrepancies with what we see in the nonprofit sector. So what happened? There were 4 charities that were organized and operated by friends and family of a gentleman named James T. Reynolds. So these 4 charities are Cancer Fund of America, Cancer Support Services, the Breast Cancer Society, and Children's Cancer Fund of America. So these organizations, they promised donors that what they were going to do is they were going to help cancer patients and their families by means of giving them cash grants to help pay for bills, giving them transportation to and from chemotherapy appointments. They would provide goods and supplies to hospices around the country. They would help pay for utilities and groceries and things of that nature. Well, from 2008 to 2012, their fundraising efforts raised upwards of over $187 million. That's quite a sum. Well, what did they do with this money? Well, in addition to their fundraising and administrative costs, which pretty much all organizations have, they also, the friends and relatives of the Reynolds family, took trips, for example, to New York City, Las Vegas, Disney World. They went on luxury cruises. They bought tickets to concerts and sporting events, paid for vehicles, college tuition, and the list goes on and on. Pretty shocking. Well, what percentage of this $180 million actually went to cancer patients? A mere 3%. How on earth did this happen? What scum was able to trick donors into these kinds of activities, pretending that they were going to help cancer patients? So we also want you to think of how would this have played out if this was a publicly traded corporation? Would this have been allowed to happen? Well, it's easy to get tremendously emotional about this scam, right? But it is our hope today that we can keep our emotions in check, because our real point is we want to convey to you the importance of this. We want to convey to you the real issue so we can come to an understanding of how do we combat this, how do we fix this, so this type of behavior cannot happen in the future. So the roadmap for our conversation today will take us through the legal dimensions of the scam. You know, who was at fault, what laws were broken, what were the penalties and consequences. We'll take you through the financial dilemmas. So what were the financial and accounting tactics that they used to scam the public? And then, of course, we will be looking at all this with an eye critical to ethical and moral issues. So what point is there really in going on if we don't first understand the, right and wrong, prey and predator, and acceptable versus unacceptable behavior? There really is no point in moving on. So we'll look at that quite closely. Of course, we want to be able to get to a point where we can come to get to some real ethical and feasible solution. So in order to do that, we have to understand what are the laws and regulations in place currently for nonprofit organizations. Once we understand that, we can move on to solutions. Finally, we will share with you a fourfold solution that we have come up with that, if followed, will benefit the nonprofit sector, will benefit donors, it will benefit those who will benefit from the programs, and it will also benefit your firms because it will mean increased business for your firms, which I'm sure you're happy to hear. So without further ado, here's the legal.
All right, good afternoon, firms. I'll be covering the legal realm of this case. So the defendants in this case were both the companies and the CEOs of each company. So they were sued jointly and severally. So that includes the Cancer Fund of America, the Cancer Support Services, Breast Cancer Society, and the Children's Cancer Fund of America. And their CEOs, respectively, were James Burnham Sr., James Burnham Jr., James Burnham Sr.'s ex-wife, Rose Perkins, and close friends of James Reynolds, Kyle Effler. So as Ted mentioned earlier, it was a small cohort of friends and family that kind of gave the background as far as how this sham went on for so long and how they had pretty much incorporated a blueprint on how to get away with this for so long. The plaintiffs in this case were the Federal Trade Commission and all 50 states of the United States. Since they are non-profitably based in the U.S., they would solicit and gain all their funds from the citizens of this nation, so that's why all states are encountered in this lawsuit. So, of this case, there was only two realms of law that was actually charged against these CEOs and these corporations, and those are based on the Section 5 Act of the Federal Trade Commission and the Telemarketing Sales Rule. So Section 5 of the Federal Trade Commission states that it prohibits unfair and deceptive acts in the realm of commerce. So the Federal Trade Commission defines the act unfair as it being harmful or could cause harm to consumers. The harm is unavoidable by the consumers, and the harm does not outweigh the potential benefits to the consumer or competition. As far as deception piece, they define it as misleading representation, omission, or practice that is misleading or can mislead a consumer. The omission, practice, or act is reasonable to the consumer under the circumstances, as well as the reputation, omission, or act is also material. So in this case, of course, as solicitors and telemarketers, they will have some material as far as what the funds are used for or what they want to allocate it for to show proof that the funds are actually going there when in fact it's not. On the other hand, the telemarketer sales rule is defined as it requires solicitors to disclose specific information about funds allocations and also prohibits misrepresentation. In addition, the telemarketer sales rule also sets a limit on how many times the telemarketer can contact an individual and also prohibits them to contact the individual after they decline being contacted, and also sets a payment restriction on how much said person can also contribute to these charities. So of these two forms of law, these are only charges formed against these individuals and corporations. So these charges include misrepresentation of program benefits, also funds allocations. As we covered briefly earlier, they would use it for personal benefits as well as nepotism as far as hiring family and friends on to gain some type of salary when they had no qualifications in that job set to be in there. Also include misrepresentation about the goods in kind that they receive and also expenses towards those goods in kind. So they would say they would fluff their numbers to seem like they got a lot of goods in kinds and they was using money to ship those out to individuals when in fact that was not the case. And also create some credibility for these firms to say that we got this much donation, so more citizens will feel obligated to donate to these charities since so many have already. Also, false and misleading filings with state legislators for tax exempt status. So they will say they made a certain amount and that they should be tax exempt for these purposes, and the funds are actually used, for their mission statement, which in fact was not. And then the last three was means and instruments of misrepresentation or deception. Also hiring staff that had these professional telemarketers that had these misrepresentations of information and also using that purposely, knowingly that the information was wrong. So going to the court rulings and damages. So all companies were said to have corporate dissolution. So all assets were liquidated and put into the STO fund. The STO fund is a fund that is guaranteed to credible nonprofits and help fund them. On the other hand, as far as the CEOs, for the most part, they pretty much got off scot-free. They were at first charged with several $1 billion to pay back in equitable relief, but based on their financial statements, it showed that they were able to provide reasonable payback for these funds. So for James Vernon Jr. and Kyle Elfler, they were set off with a $75,000 and $60,000 fee to pay to the STO fund, and pretty much that was the end of their term. James Vernon Sr., on the other hand, had more to pay back, and also some of his personal assets liquidated to go into the fund as well. Rose Perkins pretty much got off scot-free because her statements show that she had an inability to pay any sums of money. So for the most part, they really got off scot-free. And of this, the most daunting fact in this case is no criminal charges were pressed on these individuals. So you can see that at the end of the day, they embezzled over 187 million. At the end of the day, the firms or the plaintiffs of the lawsuit were lucky enough that they was able to recover $1 million of that dollar.
So in regards to the financial and business implications, these 4 charities collected over $187 million within a 4-year time span, and only about 3% of this money was actually given for charitable purposes. And they used an accounting scheme to cover up their deceitful trail, and specifically they had used overvaluing gifts in kind, and basically these gifts in kind were practically useless for patients' treatments. Items in these typical gift boxes included soaps and shampoos, over-the-counter medications, snacks, candy, just basically useless items, makeup, coloring books. And these goods were obtained at 2 to 5% of their market value, which is a huge deduction, but they were instead reported at or above their market value, so there was a huge difference. And the huge difference can be seen in one of the examples. For example, the Cancer Fund of America, they actually spent $314,000 on gifts in kind, but they reported it at $2.65 million. So now you see the degree of difference at $314,000 and then $2.65 million. And so by using this kind of tactic, they were able to improperly report over $223 million, thereby seeming more attractive and more popular to possible donors. And over here we have a graph that shows the actual fundraising expenses and employee compensation compared to the actual amount that was spent on gifts in kind and financial assistance. Now usually, according to the Better Business Bureau, effective charities usually spend 65% of their donations on program services. But as we see here, the fundraising expenses and employee compensation of these sham charities comprise of over 95% of the money that they got. And it leaves very little for the actual amount that went to charitable purposes, which is the yellow amount that you see. So it made a huge difference. And now we'll move on.
So the question is, why is this an ethical issue? People want to help others who need help. So people try to utilize their resources and channelize them to these people through the help of the charitable non-profit organizations. When these non-profit organizations use the donated resources for the benefit of some at the expense of many others, they break their moral duty towards the donors as well as the people who were due to receive the help. So donors become less and less inclined to help the people in need because of such illegitimate behaviors. So the effect is that there are lesser resources available to the people in need. So ultimately, the price for the illegitimate behavior of such organizations is paid by the donors as well as the people who need the help. What was the tangible amount of harm that was done in this case? The people of these organizations used majority of the resources of the $187 million for their own benefit. They deceived the donors by reporting $223 million of false revenues as well as expenses. They even misused the public resources because such organizations received tax exemptions from the government authorities for their charitable organizations, but they did not serve those purposes. They even misallocated the resources specifically away from the purpose for which they gathered such resources. Are the actions of such people ethically defensible? That is the question. When you get access to donated resources, you have a moral duty to use them towards a specific purpose. When the donors channelized the resources to the non-profit organizations, they had the moral duty to use them towards the people affected by cancer and their families. But they broke their moral duty, and instead they used them for their own self-interest as well as for favoring nepotism. They broke their moral duty, and the defendants misled the donors, reaped unjust enrichment, and affected the societal values. What were the rights of various stakeholders involved in this case? The donors provided their hard-earned resources to such organizations, so they had the right to receive complete and accurate information about the utilization of the resources. The people in need who were affected by cancer had the right to receive the help channelized towards them from the donors. But the people of these organizations ignored their rights towards the donors by falsely reporting $223 million of revenues and program spending. They even deprived the rights of the stakeholders of the people affected by cancer by not providing them the amount channelized towards them, and just provided like 3% of the resources towards the actual program spending. They deceived the societal values, and they affected all the stakeholders involved in the case.
Well, now we get to the point where we try to understand what are the current laws and regulations for nonprofit organizations. We have to understand this before we can get to any kind of conclusions and solutions. So these nonprofit organizations are typically tax-exempt organizations, and the way they do that, well, they're tax-exempt under U.S. Code 26, and they're known as 501c3 organizations. In order to get to that tax-exempt status, in their articles of organization, they have to list as their main purpose or multiple purposes as one or more of these purposes here, which is religious, charitable, scientific, testing for public safety, literary, educational, or prevention of cruelty to children or animals. Furthermore, the substantial portion of their activities must be in pursuit of one or more of these purposes. That's how they get into compliance with the tax-exempt status. Well, once you're a tax-exempt nonprofit organization, the tax form you fill out is the IRS Form 990. Now, this form reports several things. So it reports money and gifts, basically donations, and from what sources, whether it be public sources or government sources. You also list your administrative expenses, your funding expenses, and what percentage of your expenses, or amount of percentage, goes towards your program spending, as well as assets and liabilities of the organization. So this may sound great, right? It's got all the pieces of information we need to look at these organizations. However, there's one kind of fatal flaw with this. So we come to the conclusion, unless an organization's financial statements are prepared by an independent auditing company, such as your respective firms, and unless their tax returns are prepared by a CPA, there can really only be a presumption of honesty and integrity. So without an independent oversight, they can lie and cheat on taxes just like you and I can. So next we move on to what are some of the requirements for independent audits. This is a very crucial portion of why we have this scam. So first we look at the federal requirements. So the law states that if a nonprofit organization spends $750,000 or more from federal contributions, then that will trigger an independent audit. So what that really means is, in theory, a nonprofit organization can receive, maybe millions of dollars from federal money. However, if they limit the spending of that money to, let's say, $749,000, it does not trigger an audit. And at the federal level, there is also no financial threshold for private donations, for the amount received from private donations. Now, on a separate issue, we move on to state requirements for independent audit. So I'd like to refer you to this map. So what this map shows is state by state what the requirements are for financial audits at every state. So, for example, all the states in gray have 0 requirements for nonprofit organizations for independent audits. Now, what that means is this is the gross annual revenue. So before, we were looking at the federal requirements as what is received and spent from federal money. However, what this is gross annual revenue. So this could come from any number of sources. It could come from the public, this could come from what have you. But what we see in the states that do have financial thresholds, they're all over the place, right? So you have some from Rhode Island, for example, they basically require every nonprofit organization to be independently audited. You have Washington up here, that their financial threshold is $3 million. So if your gross annual revenue is less than $3 million, there's no requirement for independent audits. So what we see here is a huge variation in what's required. So let's think for a minute. If this was the realm of publicly traded corporations, would this fly? Absolutely not. It doesn't matter how large or small you are. If you're a publicly traded corporation, you have to undergo this audit regulations. So what we found is not only are the laws wildly inconsistent from state to state, but also the Reynolds family knew this information as much as we do. You know, they had access to this information. So any wild guesses as to where they may have incorporated? So the Cancer Fund of America was incorporated out of Delaware. The Children's Cancer Fund of America was incorporated in Arizona. The Breast Cancer Society was also incorporated in Delaware. All gray states. Are we shocked? Not so much. So also it begs the question, if you were looking to start a crooked nonprofit organization, which state would you target? So how does this involve you? Well, now that we're all disgusted, appalled, and slightly nauseous, what are we going to do about it? So, you know, the grotesque levels of ethical violations here compels us to act, compels us to do something. So the reason we have organized this meeting with you is because your respective firms, your industry, the very nature of your industry exists to promote honesty, truth, integrity, and transparency. And through these transparency and trust, promotes ethical values. So we believe that the Big Four accounting firms really should be at the forefront of nonprofit reform when it comes to accounting laws and regulations. Also, your respective firms hold a tremendous amount of power and influence in both the business worlds and the political worlds. Now, we at Charity Consulting LLC, we've identified 4 areas that, if followed, will benefit the donors, will benefit the nonprofit sector, benefit those who the programs are going to help, and will also improve your own firms with added business. So the first solution that we have kind of closes some of those issues that I mentioned before. Remember looking at the map? What we propose is lowering, at the federal level, lowering the threshold. It currently states that if you spend $750,000 or more of federal contributions. Well, we want to adjust that and lower it. So we would propose, instead of that $750,000 threshold, receiving $500,000 from federal sources. Also, at the state level, we propose a consistent state-to-state threshold of $500,000. Therefore, that closes all of those gray states and makes everything consistent. So we know that audits can be expensive, you know, upwards of $30,000 plus for larger corporations. However, those states that have a threshold already, the mode is at the $500,000 level. We know it is ethically sound to increase transparency. So large reputable organizations already are submitting to these independent audits because what they know is that independent audits adds credibility and transparency, which will draw more donors. So this, as I mentioned before, the solution would also give increased business for your respective firms.
Our next solution is independent CPA bookkeeping. So for those firms that don't pass that threshold of $500,000 or more, they have independent CPAs that keep their books for them. That way, they have the records on files as far as what every transaction is going for, what funds is coming in, what funds is going out. That just adds credibility to the nonprofit sector, and also control and scrutiny of any fraudulent activities are happening. It's affordable, more affordable for these lower and mid-tier nonprofits, as well also gives another benefit of CPA business to you all.
So for our third solution, we propose to make nonprofit organization CEOs and CFOs stand criminally liable for financial statements. And this idea parallels the Sarbanes-Oxley Act of 2002, which helps to protect investors from possible fraudulent accounting activities. And under this act, CEOs and CFOs of for-profit organizations are held liable for financial misstatements, and penalties include up to $1 million in fines and/or up to 10 years in prison. But if they are also found to have knowingly certified this kind of information, then the penalties are bumped up to $5 million and up to 20 years in prison, respectively. And by implementing this kind of same standard toward nonprofit organizations, it would allow for better transparency, more clarity, as well as help protect future donors from any possible fraudulent accounting activities.
The fourth and final solution that we present is that there should be a mandatory submission of audited financial statements and records to independent charity evaluators. These charity evaluators evaluate various charitable organizations on the basis of their cost efficiency as well as cost utilization. The benefit of this purpose will be that the donors will be able to effectively rank and allocate their resources to the most efficient and proper organization. And most charitable organizations already have the audited financial statements, but in case if that is not available, there is IRS Form 990, which can provide all the information. And these are some of the charitable institutions that are available for evaluation currently.
So what is the purpose of law? So law is generally established to protect individuals and entities from some ethical wrong. So nonprofit charities partner with donors to be able to provide help and funds and services to those who really need the help. One of the travesties of this scam was that it makes the public skeptical and less likely to give in the future. So going back to what I mentioned at the beginning, back in 2001, as with the Enron scandal, it precipitated the Sarbanes-Oxley Act of 2002, which was set up for the purpose of protecting investors and increasing transparency and trust. Well, with these solutions that we provided with you, this sort of parallels what happened with the profit sector with publicly traded organizations, but it parallels it with the nonprofit sector. So the adjustments to commercial and accounting laws that we propose would provide a greater level of trust and transparency, which would in the end give all the help given to those who actually need it instead of in the pockets of those who organize these companies. We implore you as senior executives of the Big Four accounting firms, take this information and push these changes, lobby for them in both the business and political worlds as a way to protect the ethical code by which we should all strive to live. And just to state it again, we cannot state this enough, this kind of thing cannot happen again. Well, thank you. We will take questions now.
Okay, thank you. Judges, I'd like to ask some questions. I shouldn't say judges, I should say executives of the Big Four.
Big Three?
Did you work at two of them? You want to go first?
I'm saying that there's embezzlement or fraud, which would have
if they were brought in federal court, come under the federal sentencing guidelines for organization, because the way that is written, it is for all organizations and not just for companies. And that is some fairly heavy fines. Do you have any information about
Yeah.
why?
Yeah, so as I was researching that same thing, I was thinking the same thing, like should be some criminal charges brought for it. But as I was researching, there was no criminal charges. From what my understanding is that they settled for what they're fined. At first, James Reynolds Sr., he was fighting the charges, saying that they was legitimate organizations, and the FCC was just trying to stop the corporations from continuing for this business, because during the case, they are still generating funds, they are still quote unquote a legitimate nonprofit organization. So as this is going on, they just ultimately settled for the set fine amount, and then after that, they didn't go forward through any criminal charges. Mine from also, I wish it's just lack of evidence. You're doing this for 4 years. I doubt they have any evidence as far as other than what is seen to be their chips and all this, but no documentations that actually where the money is coming from, going to like a paper trail as far as if there are actually embezzlement. It's just all speculations and all seen from just shady activity. So that's
Well,
what
they were barred, were they not, from any kind of NGO activities in the future?
Yeah.
Correct, yes.
So aside from, I mean, I agree with you. I don't know how they escaped criminal charges.
Yep.
But, so you're asking us, I mean, I can't speak for KPMG and PwC, but I think it's high time that nonprofits be audited and have an independent organization make sure that they are doing what they say they're doing. But how do you say we have a lot of influence. So you're saying that we should go to Congress, we should lobby Congress as an accounting industry?
Yes.
Okay. And what else do you think we should do? Bring in other accounting firms to join us in this pursuit of having nonprofits?
As many as possible, yes. I mean, we've paralleled this quite a few times for the presentation with what happened with Enron. That was a huge stink. That happened, everybody jumped all over that. Why is not everybody jumping all over this?
How big of a problem, I guess one of my questions, and I was similar to yours, is, but how big of a problem is this? Now, there's no question that there's a lot of gray area when you're a nonprofit, and I have experience with the nonprofit, as my side job when I'm not at KPMG. And there's a lot of, is this a fundraising expense? Is it when you get it, how you categorize that stuff in QuickBooks ultimately rolls up to how that goes, but how big of a problem is this? And there's no question that nonprofits that get big, like the United Way and other charities, can get very bloated administratively. And one of the slides, I think the last one, showed some of the organizations that help consumers navigate that. But I would ask how big, this was obviously egregious, but.
Well, I think similar to, going back to Enron again, I'm going to stop talking about them, I promise, at some point. But, were they the majority or were they the exception to the rule back then? They were the exception to the rule. This is the exception to the rule here as well. Like we mentioned, most large organizations voluntarily submit to the independent audit process. And that's because they know the results of coming from that. If they have nothing to hide, if they're efficient with their money, it will only help their organization. So I think, the majority of those out there try to do the right thing. However, there's loopholes. And the loopholes, thieves will always find loopholes and take advantage of them. So the point of this really is to isolate those loopholes and try to weed out the thieves and the crooks.
Is there another solution that, because lobbying Congress is obviously a big effort, is there?
Yes.
Are there other opportunities? Yes, it makes sense that more regulations means they have to come to us for more business winning. But is there another approach that doesn't involve the the morass of DC.
Sure.
That's a good question.
Do you agree? Well, I wish I had a better answer for you.
No,
But
saying you don't know is a good answer.
there you go, there you go. I'll be honest.
Let me just expand on that. What if we as an accounting profession, not only the Big Four, but we get other accounting organizations to join us. And what if we then presented the possibility of having audits to the more reputable charitable foundations? I mean, what if this became a voluntary kind of effort?
Right.
So that charitable foundations would want to have an independent audit because it would establish their credibility and lay out the fact that they are giving X amount of the donors' dollars to the place it's supposed to go.
Right.
Would you all consider that a possible alternative?
Yeah, absolutely. I mean, I think what needs to happen is the public, what happened with this is the public was just unaware of what was going on at the time, right? So I think in combination of what you mentioned, and as well, maybe kind of like a PR campaign, educating the public on, a charity doesn't equal a charity doesn't equal a charity, right? They're not all created equal. A lot of people don't realize that. Some people do, some people don't. But I think if we run a PR campaign somehow involving your corporations and some of the more reputable charities, then we can educate the public really on this is what to look for when you're giving your money, right? Go to these websites, look at this. There's difference between, there's difference.
Let me ask you this. When I give to a charity, personally, I find these ratings of charities that this charity gives, that 90% of the money that you give actually goes to to help cancer for children, or to help Doctors Without Borders do their work in difficult countries. Where do those ratings come from? What kind of independent ratings companies provide that? I don't know the answer. I wonder.
Well, it's like for solution
back to
number
your
4.
slide?
Yeah, we'll show you. Here you go. You want to? There you go. Can you explain it?
So these are the charity evaluators who use the rankings and
Oh, there they are. Okay.
Yeah.
But what are they basing it on? Is it because as you were talking and you were talking, PR is great, but I was thinking something along the lines of we do an audit and we certify that you are, 90% is going, and I think to your point is this self-reported or is this audited information?
That was my point. I mean,
Yeah.
how do they get that information?
And that's a cool opportunity, and that's something where that's good PR for us. Maybe we even, because it's nonprofit, we look at a reduced audit fee, a different kind of approach, and then you get, you're certified fresh, like Rotten Tomatoes, like the charity.
Did you all think about that before you did your evaluation? How these particular evaluators get their data?
A lot of it comes directly from, for example, larger firms that already have the independent audits through, I'm sure you're aware of some of your own clients that are in the nonprofit sector that use you. They will voluntarily give their information to these charity evaluators.
So it is
However,
audited information?
A lot of it, yes. And it will also tell you what the source of it is. So it'll say if it's been audited by one of your firms or whoever else. So it'll give you the level of transparency and trust that they have behind where the information comes from. However, a lot of smaller charities, or maybe some that are a little bit dubious, don't have audited financial statements. They can request legally, by law, the organizations have to give it to them, their 990 tax returns.
Okay.
So that's where they get their information from, but they also note on there, again, this is just from their tax forms, so it's not 100% verifiable.
Right, but some of them do have independent audits, and that would be much more reliable. I would think that would be a
That's a
good starting point.
Yeah.
to try to convince more NGOs to have these independent audits.
Yep.
Yeah.
Absolutely.
I'm impressed that you know that. That's good. Well, I'm concerned about the choice between self-regulation, which you just talked about, voluntary audits, and legislation that would make it compulsory, even criminal if you don't do it, potentially. What's the best route to go there? Self-regulation or compulsory?
I think part of it also kind of depends on the size of the organization, right? So obviously, a tremendous amount of legislation on a really small organization will basically shut it down, correct? I think some of the larger organizations, that's why we gave the financial threshold of $500,000 for gross annual revenue, they can sort of absorb the hit of independent audits. So I think depending on what level of finances you are with the company, the really only way to absolutely close the loopholes is through a legal solution.
Where do you think, again, $500,000, depending on the type of organization, is not a lot to have roughly let's just say $20,000 for an audit. That's a pretty high percentage of when you're saying gross annual revenue. Again, I have experience with a nonprofit where I'm on the board, and we raise $150,000 to $175,000 a year, which is not a lot. We cannot bear the cost. Like we have said we can't. Yeah. So
we also have for those smaller firms to have either voluntarily or some legislator to have an independent CPA keeping the book. So that way we have someone outside of the corporation actually going into seeing their financial statements and actually seeing if these transactions, these activities are, verifiable. So that way you can also, like I said, gain some credibility for those smaller firms that can get that certified stamp still, that they are, certified to, are verifiable, and get some more funding potentially, and then, expound their efforts.
I just think $500,000 is a slightly low.
The reason we listed it at that is looking at the map of all the, state requirements.
Right.
Those who did have a financial threshold, the majority of them, it was set at $500,000. So that's our rationale behind choosing that. But of course, obviously we're not sitting in front of a panel of legislators.
Is it gross or is it net revenue?
It was listed as gross annual revenue. So obviously we're not legislators, could be negotiable in the future, but the point is to try to make things more consistent.
But I would think as a part of a kind of independent effort, let's assume that we try the lobbying to get nonprofits to fall under Sarbanes-Oxley or some other requirement to have nonprofits be independent. Well, we could try maybe a hard road. Let's go back to the self-regulatory aspect of it. One thing that we could do as leaders of this independent regulatory movement is to prorate our charges for nonprofits and prorate them on the basis of the kind of revenues they bring in, so that it would make it perhaps more affordable for all nonprofits to voluntarily be a part of this program.
We have an opening in our consulting firm if you'd like to join.
Thank you. What do you think of that? Do you think that's...
Absolutely. If, of course, it's up to each individual firm to agree to that, but I think that's a very rational and great solution.
Yeah, I mean, it would be beneficial for us as independent auditors to have the business. And aside from having the business, it would seem to be also a part of our mission, to make sure that whether you're a profit or nonprofit, you are proceeding in an appropriate and ethical manner in your business. And going back to your point about the federal sentencing guidelines, although the federal sentencing guidelines are in fact guidelines, if in fact a corporation is found guilty of such that they are indicted, a federal judge can give huge fines for either profit or not-for-profit. So you're right that the FSGOs cover all organizations, whether they be for-profit or not-for-profit, whether they be mom-and-pop organizations or General Motors. So I'm surprised that the DOJ and the SEC didn't look into this case, because this would seem to be a case, if lack of any other laws, would fall under the FSGOs, such that, you know, they could be brought up on charges under the FSGOs.
I think some of this, I mean, it's very disturbing that there were not criminal charges, but it seems a little bit secondary to the bigger issue.
Oh, it is, but it's a travesty that these people could get away with what they got away with, and the only real punishment was they couldn't participate in an NGO kind of activity again. Of course, some of them had to pay some money, but not the amount of money that they...
Not the amount of money they took.
Any other questions?
Yeah, I would like to explore a conflict of interest possibility. In the self-regulation arena, it seems to me it's appropriate for the accounting firms to go out and encourage people to get audits. But if it's lobbying for legislation to require nonprofits to get audits, then I think maybe it's a conflict of interest for the audit firms to support that legislation.
The other option for that is, you know, of course you guys have influence in both realms, business and government. However, maybe you could use your influence talking to some of the more major reputable nonprofit organizations, right? And maybe explain to them, look, stuff like these charity scams are hurting your businesses because people will be less likely to give. So maybe put a little pressure on them, they can go lobby, right? Because number one, they're already abiding by GAAP, generally accepted accounting principles, right? And they're already getting independent audits. But this kind of nonsense is hurting their business because people are getting less. So put pressure on them as well. For them, maybe conflict of interest for you, I understand, right? But it won't be the same conflict if you have some of these other major organizations going to pressure the government as well.
I think we have to recuse ourselves
Right.
from all discussion.
I didn't think of that previously, but very valid point.
Well, I see your point, but, you know, it would seem to me that the accounting profession has an obligation to at least propose some kind of solution to this. I understand the conflict of interest issue, but I'm not sure that conflict of interest issue, as long as it's transparent, as long as the different firms are still competing for business among for-profits and not-for-profits, it would seem to dispel any kind of vicious conflict of interest. In other words, we're not saying we'd be the accounting firm to do your audit. We're saying we're one that would be willing to do it if you chose us. But what we're saying as an industry is that we think we have a responsibility to our mission to at least try to propose a solution to this problem, which you all, I think, have presented very, very nicely. But it's a good point. We have to keep that in mind, the potential for being accused of conflict of interest.
I think neither party is a great party to approach. It would have to be I think a consumer advocacy group or something like that. I think the idea of proposing a self-regulated stamp of approval that, you know, that sort of elevates what this is about, you know, in like the Better Business Bureau type thing, because people all understand what the Better Business Bureau is about. That would probably be...
If you could convince some of these charity watches or charity navigators to say, this is a great idea, let us lead the effort on your, not necessarily on your behalf, but on behalf of this ethical issue.
And it is a slippery slope when you put legislation on, because there are, there's everything from, $200 million nonprofits to, like I mentioned, the $150,000 nonprofit that I volunteer at. And there's no doubt there's corruption and all these things, but you also don't want something like my little school nonprofit to fall under and fold because of something like this.
No, certainly not. That's why I was suggesting some kind of prorated,
of course.
Maybe even a pro bono for certain charities that fall under a threat.
And that's also an interesting idea, because we've received in our nonprofit pro bono legal advice because we cannot afford a lawyer.
Okay, bell has rung. Now we can get out of our roles as executives of the Big Four, and we can talk to you person to person. So, and either of the judges want to make any comments about the presentation for their benefit?
I'll start. You guys were well prepared. You knew your stuff. Good eye contact, good poise. I think two main things come to mind. One, I think the presentation is a little too text heavy, and I think it was distracting for you, and it was distracting for me. In terms of very, like for instance, this slide here, this idea of the charity watch, like this is a big important idea, and I might have pushed some of that kind of idea up front, like, hey, people are concerned about where their money is going, they're turning to these kind of things. Look at this egregious example of what happened, and let's solve it. I don't know if I would have gone so deep into the criminal piece or the cases and the charges. And then the second thing, and this is my personal opinion, I would be careful with the tone in terms of, like, Robin Hood or hoodlum is okay, but I would be careful tonally in a business setting of using a word like scum, or, I'm not personally offended, just, and sort of the presentation just needed to be simplified a little bit. Like, hey guys, people donate to charity because it goes to their heart. They want to see the people who are hurting get that money. And oh my God, it didn't happen in this. Not only did it not happen, look at the crazy stuff that happened around it. So I think that would be, because the ethics of this just hit you in the face so much, and I think you guys let that be your shining star, because everyone, I think, gives to charity and can relate. So that's what it is.
Thank you.
I liked the presentation as it was. I would comment on the charts, and there's an example on the screen right now. The red font on the way background.
Can't read it.
It's hard, it looks fine on the screen, and we didn't have it's hard to notice when we look back from the projector.
But it was good that you gave us this.
It always seems like a good idea to use red, but it hardly ever works out right. And there's also danger in a lot of people read green colorblind, and so they don't see it at all. Maybe that's me.
No, I had the same issue.
But I thought you did a good job.
Thank you.
Yeah, I thought you did a good job too. I think you did have a lot of material on these slides. And, I am not as fussy as Dr. White is about simplify. I kind of enjoy seeing a lot of stuff, especially if it's done right. And I think you walk a fine line when you do that. Is it too much? Am I, as a journalist might say, am I bearing my lead in the complexity of the PowerPoints? I think there's a danger to that. I thought you all skirted that line, and it came off okay. But in the future, I think you have to be careful about that. And I agree with you on that. There were times I thought that you talked a little too fast. I won't single you all out, but I thought there were some times I couldn't. There was just a lot of stuff coming out. And I wanted you to slow down. Even if you had to cut back on the presentation. You know, there were things that you could have cut out that would have allowed you to explain your points a little bit more slowly, a little bit more clearly. Of all of you, I think,
I'm Ted.
Ted, I thought, did the best job of sort of slowing down and presenting the points. To various degrees, some of the others raced too fast. And I think this is a learning experience. It's not something you should take too personally. You should learn from it. And just in the future, you're going to be doing presentations when you get out into business. And you just got to realize that if you talk too fast, people are they're going to either tune you out or not get the full import of what you're trying to say. You're not the only team that did that in the 3 graduate sessions I've looked at. Not even the worst. But you got to be careful of trying to get everything out real quick because you're under a time clock. And that I thought was a bit of a distraction.
And I think that was one of the things Professor White tried to convey, and I did, it was half-hour PowerPoint presentation, it's an interesting pivot from reports that you have to do in school to how you present in a business environment. And there's a real art to distilling what you want to say on PowerPoint. And by contrast, Amazon actually doesn't allow PowerPoints. You'll come to a meeting, and I don't know how many of you know this, but you'll be given a 3 or 4 page document where everyone sits and reads it. That's the exception, not the rule. So the goal is to pull out what people need to know. And I think you'll find too, I think, well, I don't want to say you guys read from it. You guys were careful with the notes and you knew your stuff. Because there was so much text, I felt that you got a little caught up in it versus being able to tell your story. And that's where I'm coming from my business background. And the other thing I'll say, just, we're a good captive audience. If this was a real meeting, phones on their computers, it's challenging out there.
Good points, Mary. I'll just close by saying I think you all did a really good job.
Yes.
I mean, we're being,
We're being
hopefully critically constructive. All right? That doesn't mean you won't win the whole thing or anything. I mean, it doesn't mean you will either. But take it for what it's worth and take it from the fact that we're trying to be constructive.
We see the hard work. There's a lot we know.
But bottom line, for me, I thought you did a very, very fine job. You showed that you really were knowledgeable about your subject. I like the fact that I could ask you a question and you were on top of it. And that impressed me. So lots of good things to say about your presentation. And so thank you and good luck.
Thank you, Judge.